Good evening. Welcome to Potentia Wealth's Mid-Year Outlook. My name is Kevin Swanson, and I'm the CEO of Potentia. 2020 was a year unlike any other in our lifetimes. Our hope was that 2021 would be an unwinding of the global pandemic, and we wouldn't have much to discuss at this Mid-Year Outlook. Fortunately or unfortunately, that's not exactly the way it worked out. We look forward to providing a continuing education series in person, as well as online digital format in the future for our clients. We're going to be hearing from David M. Lebovitz from JP Morgan in just a moment. But I'd like to remind you that if you have questions during the presentation, please enter those in the Q&A box, and that's at the bottom of your Zoom screen. The raising your hand or putting something into the chat box won't get to us so that we can't answer those questions. We will try to answer all of the questions that we can. If for some reason we don't get to your question, please reach out to us afterwards. We'd be more than happy to discuss those with you one-on-one. Today, David will be talking to us about the mid-year economic review from JP Morgan. He's the global market strategist at JP Morgan and on the insights and strategy team. He's responsible for delivering timely market economic insights to clients across the country. David has appeared on Bloomberg TV, CNBC, and he's often quoted in the financial press. Along with an extensive education pedigree, David has earned dual MBA degrees from Columbia University and the London School of Business. And now, David Lebovitz.
All right, great. Thank you, Kevin, and good afternoon, everybody. I hope you're all doing well. So in terms of the roadmap for today, I want to start by talking a little bit about the way we're thinking through the economic growth trajectory here over the course of the next 12 to 18 months. I want to spend a little bit of time talking about the way that we believe both fiscal and monetary policy will evolve against that backdrop. And then I want to switch gears and talk a little bit about what we think all of that means for the capital markets before concluding with a few thoughts around volatility and portfolio construction. And so if we dive right in here, and as we get the slides up on the screen to share, when we think about what's going on in the global economy, generally we think the direction of travel is quite positive. There have been some concerns over the course of the past couple of weeks about a more significant slowdown in growth, the potential impact of the Delta variant on the economy into the end of this year and the beginning of next year. But generally speaking, we think that the economic impact of the variant is set to be relatively limited. And if we flip to page 2 of the presentation, you can see on this chart that looks at an economic indicator called the Purchasing Managers Index, or PMI, that the global economy continues to rebound from the pandemic quite nicely. Now, these PMIs are timely economic indicators. They're released every single month, and they tend to correlate pretty tightly to the overall pace of economic growth. 50 is the key level on the PMIs. So anytime you see a reading above 50, that indicates expansion. Anytime you see a reading below 50, that indicates contraction. But for the purposes of this chart, we are showing things as a heat map where green means good and red means not so good. Again, if we zoom out a little bit so that we can see the entire chart, you'll notice on the right-hand side that it is effectively a sea of green. The global economy, as I noted, has been rebounding quite nicely here. And that's not to say that there aren't any soft spots in the current environment. Countries like Japan, places like India continue to struggle with containing the virus, and as a result of that, have seen their economies remain under fairly significant pressure. But our general expectation here is that as we head into the end of this year and the beginning of next year, global growth should become increasingly broad and increasingly synchronized, leaving us in an environment very similar to 2017 by sometime around the middle of next year. And so the growth outlook is pretty good. The United States and Europe are set to lead the charge here into the end of 2021. And a big part of the reason why, if we flip to the next chart here, has to do with fiscal stimulus specifically in the United States. And I think everybody's pretty familiar with what's transpired from a stimulus perspective up until this point. We've pumped nearly $6 trillion of stimulus into the economy here over the course of the past 18 months. But just wait, there's more. We believe that there are not one, but two infrastructure packages which will be signed into law before year end. The first, smaller bipartisan bill tends to focus on traditional infrastructure. So think roads, rails, bridges, tunnels, so on and so forth. The second larger infrastructure package, which we believe that the Democrats will pass vis-a-vis the budget reconciliation process, focuses more on human infrastructure, things like universal pre-K for all, 2 free years of community college, and child tax credits, just to highlight a few of the things that have been laid out as part of that package. And so, again, there's been a tremendous amount of stimulus injected into the economy up until this point. We think that there is additional stimulus coming before the end of this year, but it's important to recognize that all of this spending does in fact come with a cost. And when we look at the impact in the two charts on the right-hand side of all of this spending on both the deficit as well as the debt, the question of higher taxes really becomes much more a question of when, as opposed to a question of if. And we do believe that corporate and individual income taxes will head higher in 2022. We believe that the corporate rate will move from 21% to 25%. We believe that the top marginal rate for individuals will move to 39.6%. And we do believe that capital gains taxes will increase as well. But to us, none of those things are a structural headwind for the economy or the capital markets more broadly. And given our expectation for above trend growth and given our expectation for continued robust growth in corporate profits, we do believe that the economy and markets will be able to take these increases in stride. Now, while all of this spending has undoubtedly drummed up fears about a potential increase in taxes, it has also drummed up fears, if we flip to the next slide and zoom out just a little bit more, it has also drummed up fears about the potential for a significant increase in inflation. When we think about the inflation environment, and you can see over on the far right-hand side of our inflation heat map, that price growth has accelerated pretty meaningfully here over the course of the past couple of months. We always expected inflation to be running hot during the back half of 2021, but we stand by the view that inflation will prove to be transitory when all is said and done. That said, and I'll go into this in more detail in just a minute, we do believe that inflation could prove to be a bit stickier than what a lot of folks have currently penciled in. Now, when we look at where the inflation has been coming from over the past couple of months, it's come from the parts of the economy which were hit hardest during the pandemic. So think airfares, hotel rooms, used car prices, so on and so forth. But we are seeing signs that inflation is broadening out and particularly showing up in things like restaurant prices, which we believe is an indication that the increase in wages that's been observed over the course of the past couple of months is being passed through to the end consumer vis-a-vis higher prices. And so if we flip to the next chart here and think a little bit about the labor market dynamic and what's been going on with wages, you can see that gray line is the unemployment rate. You can see that light blue line represents wage growth on a year over 2 year basis. And we show it that way to try to smooth out some of the impacts of the pandemic, excluding the spike in wages that we saw in 2020, which was really driven by compositional effects in the labor market when all was said and done. Wage growth on a year over 2 year basis is running at its fastest clip since the early 1980s. And there's been some research done by a group of economists at UC Davis and the San Francisco Fed. And actually what they've uncovered is that usually after a pandemic, you begin to see income flow back to labor as opposed to continuing to flow to capital. And so this is something that we've spent a lot of time talking about over the past couple of years, that labor wasn't getting paid adequately, and income was instead just being sent towards corporate America. There's reason to believe that dynamic may in fact begin to change. And so we're going to watch that very closely as a continued robust wage inflation situation could very well translate into inflation that, again, is a little bit less transitory and a little bit stickier than what consensus and the Federal Reserve are currently forecasting. And so if we flip to the next chart here and think a little bit about the outlook for the Fed, generally speaking, I think that the Fed is going to take their time when it comes to the normalization of monetary policy. I believe that they are going to take an approach characterized by measuring twice and cutting once. But we have seen signs over the past couple of weeks that the Fed is beginning to think more about eventually moving towards the exit. And it does sound like the Fed will announce the tapering of their asset purchase program at some point later on this year. We believe that the formal announcement of tapering will come in November. We think that they'll give little previews and little teases over the next couple of months to get the market ready for, again, that formal announcement when they convene in November. We then believe that the Fed will spend the better part of 2022 tapering the pace of asset purchases down to zero. And then 2023, they'll begin to entertain the idea of hiking rates. But you can see in the bottom right-hand corner of this slide that the Fed and the market are expecting 2 interest rate hikes in 2023. We take the under on that. I think that the Fed is only able to go once in 2023, because something that they spent a lot of time talking about in the aftermath of the financial crisis was the idea that monetary policy operates with a lag, right? So put differently, what the Fed does on any given day takes about 6 to 9 months until the impact shows up in the real economy. And so if the Fed tapers asset purchases down to zero, say by the end of the third quarter in 2022, the soonest by my lights that they would begin to think about hiking rates would be the second quarter of 2023. And then you need to ask yourself, do they really try to punch in another rate hike there before the calendar turns? Or again, do they err on the side of caution, which seems like a much more reasonable approach given what the Fed has done here in response to the pandemic over the course of the past 18 months. And so if you had been asleep for the past 10 years and you woke up and attended this webinar and you heard everything I just said, you'd probably be thinking, wow, that's a pretty good setup for the capital markets. You have an economy that's coming back online. You have a virus that's being slowly but surely brought under control. You have monetary and fiscal policy, which remain accommodative. And you have inflation, which is running a little bit hot, but not necessarily problematic. The one rub in the current environment is that when we look at valuations, pretty much everything looks expensive. And if we flip to the next chart here, that is particularly the case when it comes to fixed income. Now, what we're looking at here on this chart, the position of the diamonds relative to the x-axis represents the correlation of each of these sectors to the S&P 500. And then the position of the diamonds relative to the y-axis represents their average yield over the past 12 months, hedged back into US dollars in the case of those international markets. And to an extent here, you can see that the bond market is somewhat broken. You look down in the bottom left-hand corner of this chart at things like US Treasuries. Yes, in theory, they zig when the equity market zags, but they're not really paying you anything when all is said and done. And then you juxtapose that with what we show in the top right-hand corner of the chart, things like high yield and EM debt. These are assets that are paying you a more robust stream of income, but tend to move in lockstep with the equity market at large. And so we're big believers in this environment in taking a barbell approach. When it comes to building that core fixed income allocation, right, the ballast of our portfolio, we actually want to move away from treasuries to a certain extent and instead embrace things like investment grade corporates, securitized paper, and in some cases, municipal bonds, where we think we can pick up a little bit of additional yield without adding a significant amount of risk to our overall portfolio. And then we are comfortable owning things like high yield and EM debt. We recognize that they're not going to provide protection in the event of an equity sell-off, but they are going to give us the income that a lot of our clients obviously need. Now, when it comes to investing in those more extended parts of the fixed income universe, we're big believers in maintaining a higher quality bias. This is not about bottom fishing and trying to find the securities that have the highest yields. Rather, it's about finding the best risk-adjusted yield in those markets and adding those securities to a portfolio in an effort to enhance the overall stream of income that the portfolio is able to provide. So fixed income is challenging in the current environment, but importantly, challenging does not necessarily mean impossible. If we flip to the next chart and think a little bit about the outlook for equities, the market has come very far, very fast. Actually, earlier this week, the market from a price level standpoint had doubled since the March low in 2020. And you look at valuations today, and again, stocks look kind of expensive. They look cheap relative to bonds, but everything has somewhat of an elevated valuation in the current environment. And so we're not sure that valuations can really continue to increase. And when it comes to equities, if valuation isn't going to be driving your return, well, then you need to rely on earnings. As you can see on the far right-hand side of this chart, the earnings outlook for 2021 is extremely strong. Standard & Poor's is currently estimating annual earnings growth of nearly 65%. Again, for the S&P 500. But what's most interesting to us is not necessarily the level of earnings growth that people are expecting this year, but rather the parts of the market where that earnings growth is going to come from. And while technology stocks and healthcare stocks have done very well, particularly in 2020, we do believe that value looks more attractive relative to growth. We think that sectors like financials, industrials, materials, maybe even energy, those are the sectors that are going to do the heavy lifting when it comes to earnings growth going forward. And as a result, we want to position portfolios so that they can lean into those sectors. One, because the relative valuations are more attractive, but two, because the earnings story looks like it is going to be particularly robust. So we're very comfortable taking risk in US equities. We do want to lean into value. That doesn't mean that we're getting rid of growth. We like technology for the long run. We simply see a tactical opportunity here in the more cyclical parts of the market. Now, if we jump to the next slide and think a little bit about the rest of the world, coming into this year, we were of the view that the dollar was going to weaken. That is very much the way that things played out at the beginning of this year, but over the course of the past couple of months, the dollar has been much more range bound, and that's coincided with a cooling off on value and a reassertion of growth from an equity market performance perspective. But we do believe, if we go back to one of the points I was making on the very first slide, we do believe that as global growth becomes increasingly synchronized into the end of this year and the beginning of next year, that the dollar should resume its downward move, thereby providing support for international markets in particular. And I'll talk a little bit more about international equities in just a moment. But before I do, what's kind of interesting about the current environment is that we not only expect the dollar to trend lower into the end of this year, we expect the dollar to trend lower over the long run as well. And the reason why is best illustrated by the chart in the top right-hand corner. What you can see there is that the United States runs a chronic trade deficit, a chronic current account deficit. And effectively what that means is that we are a net borrower of dollars from the rest of the world. Historically, countries that run big trade deficits, big current account deficits, tend to see their currencies depreciate over time. And so the interesting thing today is that whether we're talking about the next 6 months or the next 10 years, we believe that what has been a headwind in the form of a stronger dollar, particularly over the course of the prior cycle, should evolve into more of a tailwind here going forward. And if we flip to the next chart and think more granularly about the opportunity in markets outside of the United States, for years, people have been showing charts like the one on the right-hand side and saying, look, you should buy international stocks because relative to the United States, they continue to look cheap. For anybody who's been to the dollar store recently, they have lots of cheap things on their shelves, most of which you probably don't want to take home with you. To me, I'm always looking for assets that are attractively valued, but I want to own them in a macroeconomic environment which is conducive to their outperformance. And the chart on the left-hand side, and more specifically those light blue diamonds, highlights that the rest of the world is far more cyclical, far more value-oriented than is the case in our own backyard. And so those blue diamonds represent the share of each of these markets, which is comprised of cyclical sectors and cyclical industries. And you can see that places like emerging markets, Europe, and Japan are far more oriented towards cyclicality, far more oriented towards value than is the case here in the United States. And so we're finding things to do in Europe. We're finding things to do in Japan. We're finding things to do in the emerging world. And another way to think about this is if you agree with my view that investors should be leaning into value relative to growth here in the United States, then you would inherently agree with my view that investors should be leaning into the rest of the world as opposed to the US. And so if we flip to the next chart here, what I would say is that overall, we are very constructive on the medium-term outlook. We are still very comfortable taking on risk in the context of a diversified portfolio. But I do think that it's important to recognize that we've had this uninterrupted run in equities effectively since November 9th of last year. What we're looking at here on this chart, the red dots represent the peak to trough decline for the S&P 500 each year back to 1980. And then the gray bars represent the full calendar year return. We put the punchline right up in the subtitle. On average, during the past 41 years, the stock market has fallen by about 14% during the course of the year. However, in 31 of those 41 years, or approximately 75% of the time, the market has then gone on to finish the year in positive territory. And so put differently, if the S&P 500 was a baseball player, it would be batting 750. It would be the best hitter in Major League history by a factor of 2. Again, volatility is normal, but equity markets are resilient. And if you look at the far right-hand side of this chart, again, you'll see that the peak to trough decline for the S&P 500 this year is a mere 4%. That is abnormal. And so I do think that markets could get a little bit choppy here as we move into the dog days of summer and the beginning of fall. I would not be surprised to see some sort of a correction here before year end. But given our view on the economic outlook, given our view on corporate profitability, we would be buyers of any pullback because we do believe that over the long term, the fundamentals do continue to look quite supportive. But if we flip to the next slide, it's important to recognize that the problem with volatility is that it makes people emotional. And when people get emotional, they often make ill-informed investment decisions. What we're showing up here on the top chart, we assume that emotion got the best of you and that you invested $100,000 across 3 different portfolios at the market peak back in February of last year. We assume that you put $100,000 in a 40-60 stock bond portfolio, which is the dark blue line. We assume that you put $100,000 in a 60-40 stock bond portfolio, which is the light blue line. And we assume that you put $100,000 in an all equity portfolio, which is the green line. And, look, all of these portfolios lost money during the early days of the pandemic. The question was really how much. But look at some of those recovery times. That 40-60 portfolio recovered its losses by the beginning of June. That 60-40 portfolio, well, it took a little bit longer, but it recovered its losses by the middle of July. It would have taken that all equity portfolio until the middle of August to recover its losses. And I was showing this chart to a client the other day, and they looked at me and they said, well, it doesn't matter because everything recovered so quickly. Well, that's really a function of the policy supports that were very quickly put in place in March and April of last year. If I were to show you the same chart, but looking at the financial crisis, you would see the same general trend. Diversified portfolios decline less and more often than not, recover their losses before a pure play on US equities. And the thing here is that we need to keep the ride comfortable. Because if the ride gets too bumpy, then people end up doing precisely the wrong thing at exactly the right time. They end up buying high and selling low. And the return of that investor is represented by the orange bar down at the bottom. That's the return of the average investor. That's the return of the person who doesn't have an advisor, who doesn't have a plan, and who instead allows emotion to dictate their investment decisions. We can see very clearly that the average investor is frankly a pretty lousy investor. On the other hand, if you had been in a simple 60-40 or 40-60 portfolio over the course of the past 20 years, you would have generated an average annual return of around 6% per year. But importantly, you would have done so with considerably less volatility than the S&P 500. And so if we flip to the next chart here, I do think that the easy money has been made. I do think that successful investing going forward will consist of hitting singles and doubles. But more so than anything, we believe that a balanced and diversified approach to investing will win out over time. What you can see here are the annual returns of a number of different asset classes, and then a balanced portfolio comprised of those different asset classes, which is the gray box connected by the black line. Now, that balanced portfolio, it's never the best performer, but it's also never the worst. It trends right along the center of the chart, providing clients with a smoother and more comfortable ride over extended periods of time. And I will be the first to admit that diversification works over time. Diversification doesn't work every time. But as we just talked about on the prior slide, diversification certainly worked in your favor during the pandemic in 2020. And at the end of the day, we believe that a diversified approach to investing simply makes the ride more comfortable. And we're big believers that if we can keep clients comfortable, we can keep them invested. And if we can keep people invested, we can improve the chances that they successfully accomplish their long-term investment goals. So with all that said, I'd like to thank you very much for your attention this afternoon. And Kevin, I will pass things back over to you to dive into some Q&A.
Thank you. If you do have questions, please go ahead and put those into the Q&A box. We'll start with the first question here. We've had a recovery here in the United States from the first, second, third wave of COVID before the variant has showed up, and we've gotten ahead of that here in the United States, more so than, say, Europe or Asia. As we see a rolling out of this or unwinding of the pandemic on a global basis, do you see more returns in the future from overseas more than the United States?
I do. I mean, the United States has really been the belle of the ball here for the better part of the past 18 months until, earlier this year. Europe, the emerging markets, Japan, they weren't really participating the way that everybody, was kind of expecting them to. And so as US markets have kind of regained that lead, we're increasingly interested in those markets that have lagged. We do believe that over time that there's some sort of symbiosis between markets around the world where, sometimes the US is in front, sometimes Europe's in front, and there's not a single horse that's always leading the pack. And so when we think about more attractive valuations, when we think about the potential for a more synchronized global growth environment next year, and importantly, we think about the potential for a weaker US dollar, I would say the short answer to that question is yes. We are increasingly constructive on investments outside of the United States, given the magnitude of returns that have been generated in our own backyard since the low in March of last year.
Craig is also fielding questions for us. So as those come up, Craig, if you'd bring those up as well. One additional question that we had is, you said that you didn't expect much impact from this new variant of COVID. And yet I was traveling in Portland. I hear that their hospitals are 85% full right now. The ICUs are more impacted by ICU patients than they by COVID patients than they were back in November. Do you not see that having a economic impact as we move forward?
So I think the question on the economic impact is do we lock down the country the way we did in March and April of last year? And I just don't see that happening. In the Northeast where I am, weeks ago, we started to put our masks on when we were indoors. Now it's become official. I went to go mail a letter today and had to go into the post office, big sign right on the front door, mask required for entry. But even with those types of restrictions in place, people are still going out to eat. They're still going to bars. They're still going shopping. And so, the humanitarian and the health issue here is not something that I'm trying to sweep under the rug. I guess my point is more so that I would be very surprised if we decided to shut down the economy again, because based on what I'm seeing and hearing, we've effectively severed the link between virus spread and mobility. It's no longer a case of, cases are growing really rapidly, everybody stay at home and hoard, Clorox wipes. It's cases are growing rapidly again. You need to be thoughtful about what you're doing, but you can still go out to eat. You can still go and buy, clothes at J. Crew or wherever you go shopping. I think that the economy is just in a very different place today, particularly from a policy perspective, than was the case, say, 18 months ago.
We have another question here about, you said that inflation is transitory. Could you define transitory, and how long does transitory exist?
So transitory, I would say, is the investment community's favorite buzzword, and everybody defines transitory as something that will come and something that will then go, but nobody wants to put a time horizon around it. And to me, that's really the significant issue at hand. And so you look at the Federal Reserve's own forecasts; they believe that inflation will be back down around 2% by the end of 2022. I think it's going to take a little bit longer than that. I don't think we're embarking on a 1970s period of inflation or 1970s style inflation here over the course of the coming years. But I do think that inflation is going to remain elevated into 2023. And at that point, by the end of 2023, I believe that a lot of this will have finally run its course. But you look at what's going on with service price inflation in the form of higher wages, and just using restaurants as an example. You look at supply chain disruptions. I'm trying to buy a family car now that I've moved to the suburbs. Used cars cost as much as new cars in the current environment. And so I think inflation is going to be a little bit stickier. To me, transitory means, call it 2 to 3 years, as opposed to the 1.5 to 2, which seems to be the dominant narrative amongst the investment community.
Yeah. Got a question here regarding the supply chain disruptions. I'll give an example of this. Today I went to a restaurant. They didn't have chicken. And so chicken's not something we're bringing from overseas. I heard a report that we've got soybeans stocked up. We can't get them sent out overseas or even throughout the United States. So what's causing that?
So a couple of things are causing it. One is that there has been tremendous demand for goods, and there has been effectively no inventory rebuilding, not just in the United States, but more broadly around the world. And so, you think about the issue of, let's use sneakers as an example. Let's say Nike had an inventory of 100 sneakers when the pandemic started. Well, part of what happened was that, for the better part of a year, people could buy stuff, but they couldn't go out to dinner. They couldn't enjoy services. They couldn't go on vacation. So people, they bought a pair of shoes, whether or not they needed it. And what happened was the inventories got lower and lower and lower. And because they had trouble keeping manufacturing plants open, because of now what's going on with supply chain disruptions, anecdotally, we're hearing that ships are sitting outside the port of Los Angeles for 5, 6, 7 days, just waiting to unload their cargoes. We've ended up with this issue where there's tremendous demand, but somewhat limited supply. And the same is true for chicken. I actually saw something similar the other day. They're very worried about the turkey supply come holiday season, because in order to get those live turkeys ready to go for Thanksgiving and Christmas, right, they need to think about that something like 9 to 12 months in advance. And so it was really an issue of lack of preparation, which has brought us into this environment. But again, we believe that as the economy continues to reopen and as we move past the Delta variant, consumption will once again become more balanced between goods and services, and that will allow some of those supply chain and inventory disruptions to gradually run their course.
Hey, David, I have a question. By the way, if we don't have turkey for Thanksgiving, I'm good with that. If I'm forced to barbecue a prime rib, I'm all good. Hey, one of the first slides you put up, the PMI slide, the Purchasing Managers Index, for the most part, had shown that most countries were above 50. Above 50 is good. It was all in the green. How is it that with the rollout of vaccines being much slower to less developed countries, that they're still kind of firing on all pistons as it relates to PMI? Why isn't there a disconnect there?
So I will say that the majority of the data points on that slide are developed market countries. So, Europe and the countries within the Eurozone, the United States, Canada. Japan looks particularly soft. That's an example of a country that's still struggling with the virus. India looks pretty soft. China has decelerated here as they've seen case growth pick back up. And for them, they were kind of the first ones to come out of this. So they're coming down from a higher level, whereas, in the United States, we're effectively still ramping up. And then you have these kind of one-off cases of places like Brazil, where, the fiscal response, the government response has been very robust and helped to prop up growth. But, when we look across the PMIs in Southeast Asia, and again, we don't show a lot of those on the slide, you're still seeing below 50 readings in places like Indonesia, Malaysia, right? Countries that are struggling with spread of the virus. And so, I could show you a chart that effectively highlights the ability of a country to get their PMI above 50 is almost one-for-one linked to the efficacy of their vaccination programs.
Great. Kevin, if you don't mind, I have another question. Can we talk about energy in particular? Over the course of, let's call it a decade, the U.S. had become the largest producer of oil and gas in the world, and there's been a lot of changes in that arena. What does that say for the future of, let's call them frackers in the United States? Where are we at on that? And I would just add on to that specifically that there's a lot of debt associated with that industry. How do you see that unraveling itself?
So, I actually think that the direction of travel here has become much more positive in the sense that you're right, the frackers are saddled with a lot of debt. And up until this point, they've been in the volume business, right? To them, it's about how much oil can we get out of the ground, as opposed to how much oil should we bring out of the ground in order to generate a decent stream of profits. And what you're hearing from the investment community is that they want more discipline within the fracking industry broadly. They want less of a focus on volume, more of a focus on a combination of price and volume. And furthermore, that's an industry which is pretty ripe for consolidation. And so not every fracking firm is a good fracking firm, but there are some pretty good ones out there. And we're very much of the view that the combination of M&A activity alongside more capital discipline within these companies and a greater focus on cash flow as opposed to volume could begin to allow the clouds to break over a sector and an industry that's obviously been in the doldrums really since 2015. But the reality is we are a world awash in oil, and the frackers can be profitable at 45. And so it's much more about not pumping so much oil that you send the price down to 45, but figuring out that equilibrium where you can maintain some decent profitability while continuing to generate a meaningful amount of volume.
I would remind you, we don't have any questions in the queue. Now, we do have one question, but I'll go ahead and throw it out there. It's a little bit of a hypothetical, and maybe it's our worst fear as a country, but in the event Delta continues on the same trajectory, how do you see that playing out in terms of, is the U.S. economy on solid enough footing that it would not cause devastation, let's call it, again? I realize that's a little bit on the crystal ball side, but I'd be curious on your thoughts, or we have a question from the audience, I suppose, so I want to ask it.
So I think that on the virus, things would really have to start going sideways. And I take the point, Kevin, that you made earlier about hospitalization rates being up. It is primarily amongst unvaccinated individuals. And we should probably save that topic for another point in time. What you haven't seen, however, is a commensurate rise in deaths, at least in areas where vaccination rates remain relatively high. And so to me, the only thing that would get the US economy locked down again and precipitate some sort of significant pullback in the overall pace of economic activity would be some sort of development, some sort of variant that is causing the number of deaths to increase alongside the number of cases and hospitalizations. Again, we're not really seeing it in the current environment. It sounds like we're going to err on the side of caution, and people are going to be getting booster shots here in the next couple of months. But the death number is the one to watch, because that's what potentially could get policy moving in a more restrictive way. I'm
going to ask one more, and then we'll wrap it up unless something shows up in the queue here, David. you spent a fair amount of time already talking about inflation and the rising of rates, right? That's something that I pay special attention to, right? And we've already talked about, what is transitory, right? In fact, I've asked some of the folks I work with, stop using the word, transitory, right? However, the first time I've really heard it lasting as long as into 2023, I believe you said, that's the first time I kind of heard that. So this is not something that goes away anytime soon, right? But at what point, because rates in the business, as you know, we talk about it, taking away the punch bowl when the Federal Reserve raises rates, the party's over, right? Do you think that's a risk, or can we find confidence in the fact that for the most part, the current Federal Reserve Board is very dovish and, a knee-jerk reaction to raise rates, which does rattle the markets, is not going to happen? How confident are you that that'll get played out just right?
I think that this is a Fed that errs on the side of caution and takes an approach where they measure twice and cut once. I mean, you would need to see a significant spike in inflation and an unexpected spike in inflation. And furthermore, that spike then sustained over some period of time to get the Fed to shock the market with an interest rate hike. I think they recognize the delicate balance that they've created. They recognize the punch bowl dynamic. We used to talk about bad news being good news because it meant that the Fed wasn't going to move to tighten policy. And I don't think that this is a Fed which is going to behave in that way. And I would just make one more point, which is that it's important not to forget that when the Fed starts to raise rates from very low levels, that's actually a good thing, right? That's the doctor saying the patient can get out of bed. They can take a walk down the hallway. They might not be ready to go home and stand on their own 2 feet, but the recovery is proceeding as expected. And so, don't be afraid of the first couple rate hikes. Yes, they may cause a bit of volatility, but the potential for them to cause a significant pullback in the market feels relatively muted, given the general messaging that we've heard out of the Fed over the course of these past couple of years.
Thank you. Okay, there are no more questions, so I'm going to go ahead and wrap it up. And I'm going to start by extending a very warm thank you to you, David. This is, I don't know if this is the third, fourth, or fifth time you've been kind enough to do this or so. Thank you for sharing your perspective and thoughts on the global markets. And Kevin Cruiser, I want to thank you as well for your support this evening, making David available to us, not only tonight, but throughout the entire year. I want to thank the Potentia staff. They work behind the scenes diligently to make sure that all of the details are paid attention to, as they always do. We're in a business of paying close attention to details. So thank you for that. And to our clients, I want to say thank you for staying engaged in the process and being collaborative with us. It makes our job easier when you stay informed and up to date. So thank you. And as Kevin mentioned at the beginning, we hope to see you all in person at live events in our office as soon as conditions allow us to. But we miss having those events in the office. We look forward to that. So thank you for attending. Have a great rest of the evening and a great rest of the week. Thank you and good night.
Thanks, everybody.